Revaluation of fixed assets. Question 1, 2011. We find factory buildings costing 550,000 in the trial balance. The depreciation at the start of the year is 110,000. And there's no revaluation reserve at that time. The depreciation for the year is 2% of cost. So 11,000 is our depreciation. And then the question tells us that we're revaluing the buildings up to 650,000. So we've got to end up in the balance sheet with a net book value or a revalued figure for buildings of 650,000. And we do that by increasing the cost hereby, or by adding 100,000 to the cost. That brings us to 650,000. But don't forget to cancel all of the depreciation up to the date of revaluation, which is 121,000. And this then gives us our surplus on revaluation, which we treat as a capital reserve in the balance sheet, of the sum of those two figures. The 100,000 increasing the cost figure, plus the 121,000 in cancelled depreciation. So our balance sheet will show, if we put our final accounts separate from our balance sheet, factory buildings at their revalued figure of 650,000. The depreciation is gone. Don't forget the 11,000 to charge as a manufacturing overhead. Remember, it's a manufacturing account, so depreciation of factory buildings will be a factory overhead or an indirect cost. And the surplus on revaluation of 221,000 will go into the balance sheet as a capital reserve. Ensure that you put the revaluation reserve on the capital side in the balance sheet before you put in the profit and loss figure. Question 1, 2011. Revaluation of fixed assets, the treatment of depreciation and the revaluation reserve.